Did you see the stock market action this past week? The S&P 500 rose a full 5 percentage point, with different companies in different sectors actually posting double-digit gains. All of this in just a week. But I'm sure all of y'all have kept up with the news that's going on as well. COVID-19, George Floyd, protests, riots. How the hell is the stock market going up with all of this news in the world? Well, we'll explain to you why. Snack on this, the state of the market. Stock markets tend to bounce back after sharp drops, but that growth and recovery comes usually in a pretty decent amount of time. We, however, live in unprecedented times, and the sharp drop that we saw as a result of COVID-19 had rippling effects throughout the globe. Global markets were shattered because company after company were lowering their guidance for their earnings for the remainder of the year, given the impacts of COVID-19. Earnings guidance, just to give you a brief synopsis of what that is, are when a company lets investors and the stock market know what it can reasonably expect as a result of its financial modeling in the next quarters. So, for example, let's take Nike as a stock. Because of all of the COVID-19 issues and because of the supply chain difficulties that they've had, that's a company that would lower their earnings guidance because reasonably they're not getting their shipments out on time, they're not selling as much in their brick and mortar stores, or their brick and mortar stores are closed. As a result, the stock market will respond appropriately. The stock market, that particular stock, will drop because they won't be posting as good results from the market. Now, a company like pharmaceuticals would fare very well, especially since a lot of some pharmaceutical companies are dealing with COVID-19 related drugs. So, creating these drugs, if they get into stage 1, 2, or 3 trials, the news comes out, they're predicting or analyzing or forecasting that they do really well, those stock prices are going to go up. That's what earnings guidance sort of is basically the company telling the public or releasing information where they stand for the remainder of the year. Companies will raise guidance in periods of prosperity, when the company is doing well, or when the overarching market doing well, and they'll lower their guidance for everything opposite of that. We saw sharp declines when everything started, but what's going on now? Why is the market going up when there is seemingly no good news coming out of anywhere? Two things: unprecedented stimulus as a result of COVID-19, and folks like me and you who are now investing and not wanting to miss out on arguably what are going to be one of the best times of return during our lifetime or our generation. Stimulus is a word that gets thrown around a lot, and not everyone knows what it means. But let's break it down for you. A stimulus package is a number of incentives or tax breaks offered by the government to boost spending to prevent an economic downturn or to bring a country out of a recession. It comes in the form of either monetary stimulus or fiscal stimulus and has aspects of what we call quantitative easing. Let's get into those. Monetary stimulus is what we refer to as cutting interest rates. This allows companies and people to borrow money very, very cheaply because interest rates are the cost of borrowing. So when that gets reduced, companies and people can borrow money very, very cheaply. This in turn provides people with more incentive to buy bigger purchases such as homes, cars, take out personal loans for businesses. As a result of more borrowing, more money will be circulated in the economy. This also creates less incentive to save because not only does the cost of borrowing get cheaper, but the rates that you receive on your savings accounts also goes down. So people save less, therefore they're putting more money into the markets as a result. And by markets, we mean anything. It gives people more of an incentive and reason to spend because they're no longer getting the benefit of a high interest with the money sitting in their savings accounts. Fiscal stimulus refers to cutting taxes or increasing government spending to revive the economy. Tax cuts lead to more money in everyone's pockets. So with more money in your pocket as a result of tax cuts, what you're seeing is people go out to spend more money because they have more money to spend. This is more income at your disposal. So more income at your disposal leads to more spending throughout the country. Government spending injects more money into the economy and in turn decreases unemployment as a result. And we saw a direct correlation of this when the government came out with those stimulus checks, with the payroll protection program, things of that nature that allowed small businesses to stay afloat with government money, allowing those funds to be completely forgiven. All of these measures to counteract the effects that COVID-19 had on the economy. So, as a result, government spending decreases unemployment rate, increases spending, and counters a lot of what happens in a recession. That's the fiscal stimulus for you. Quantitative easing sounds very complicated, but at the core, it means that the Federal Reserve will start buying bonds or other financial assets from banks and financial institutions. These purchases in huge amounts increases the excess reserves that these companies have, which increases the money supply in circulation. What quantitative easing does is it signals to the markets and investors that the central banks, which is the Federal Reserve in the case of the United States, is willing to do all that it can to counteract the effects of a slowdown in the growth or an oncoming recession. This in turn drives the price of stock market equities higher because investors feel that there's a safety net guarding their investments because the Federal Reserve will come in and step in where, when, and how they need to do that. Again, look at this as a safety net for investors. The government stepping in to help the stock market rise. With all three things at play and understanding the very basic mechanics of how these things work, can you now reasonably believe that the stock market wouldn't recover? The second reason has a huge impact too. With so much knowledge out there and with our generation investing more and more, folks just simply don't want to miss out on the gains of a lifetime or the gains of a generation. Lifetime becomes too long in things like this. Lifetime becomes too long in things like this. Let me explain what this means. At the height of the market crash in March, the market had dipped about 35% from its highs. And this was in the span of just a few weeks. It's jarring to hear about, but investors still flocked because it was an opportunity for them to average down in their portfolios. Almost every stock looked like it was discounted from the valuations it was at. Was the market overbought at that point? Sure. But after the crash, a lot of these stocks seemed like great discounts for the long term. Although there were overarching reasons that the market was sinking, averaging down for the long term never hurt anyone. So what you saw was investors were buying up more of these stocks, especially after hearing about all of the precautions that the government was taking in literally injecting money into the markets and into the economy. When you're looking at long-term levels in the market, you see some dips and setbacks, but for the most part, the stock market's gone up over time. So why not take the once-in-a-generation opportunity to buy low or average down your costs? It simply makes sense, right? This type of mindset is what drives a majority of the investors in our generation and what we wish to impart to you as you go on in your journey in building your portfolios, in understanding investing. This is sort of the long-term approach we keep repeating for you to take because it proves time and time again that it works. Now, it does help that the government is literally injecting trillions of dollars into the market. But on the flip side of things, where else are you going to get dips of 35% in a month? Barring another catastrophic world event, from which, as the government's shown, it is willing to step up and take the actions necessary to support a falling market. With all of that information at your disposal, wouldn't it make sense for you to continue to average down as you see fit and continue buying on the way up? In our perspective, it definitely would. So, with the measures that the government's taken, and a renewed mindset about long-term investing, and the benefit that these dips can provide, can you really be that surprised that the market has recovered in the time that it has? Is it a sharp turn upwards? Sure. Will there be more dips and ebbs to follow? Of course, that's just the way these things work. But you can prepare yourself for that by keeping a little bit of cash on hand for when those market dips do occur. This is why we recommend that weekly, bi-weekly, or monthly approach so heavily. It automatically lets you get into the market at those specific intervals, whether stocks are sinking or whether stocks are rising. You're investing your money and taking advantage of everything that the market is doing. So with that, it makes sense that the market's recovering. It makes sense that the stock market is going up. Like we mentioned earlier, is it a little sharp upwards? Of course it is. But it's a recovery that's supported by the safety net that the government is providing. And it's not just the Federal Reserve. Governments across the world are providing quantitative easing for their respective countries in order to give a safety net to investors to let them know that they are willing to step in. So with that, until next week, our only advice, keep investing, and keep investing.